The Federal Reserve's role in the financial markets has expanded from a modest participant into a multi-trillion-dollar force. It now maintains a massive footprint across the entire U.S. banking sector. Newly appointed Fed Chairman Kevin Warsh has argued that this footprint is now too large. He believes a balance sheet this size distorts market signals and blurs the lines between monetary and fiscal policy. Starting in 2022, quantitative tightening successfully reduced the Fed's total assets by $2.4 trillion, dropping from a $9 trillion peak to $6.5 trillion in 2025. But that progress is reversing, with total assets climbing back to $6.75 trillion last week. Even with the leadership's stated desire to shrink the institution, the data reveals structural forces that are compelling the balance sheet to grow again. To understand why the balance sheet is expanding, we have to look at the specific asset class the Fed is currently targeting. In late 2025, the Fed began reserve management purchases. They are now buying $40 billion of Treasury bills every month. The Fed explains these purchases are necessary to accommodate the banking system's demand for reserves, maintaining an ample level of liquidity. This contradicts the traditional view that a hawkish Fed can simply sell off assets to tighten conditions at will. This suggests the size of the Fed's balance sheet is no longer a discretionary choice, but is instead bound by a hidden regulatory framework. We can see the shift by looking at how central banking functioned in the decades before the 2008 financial crisis. Under the scarce reserve model, the amount of bank reserves held at the Fed was remarkably low, averaging just $30 to $50 billion for decades. This compares those reserves to M2, the total money supply. Reserves were roughly 10% of total bank deposits. Because reserves were scarce, the Fed influenced interest rates with very small operations. Adding reserves eased policy, draining them tightened it. This allowed the Fed to control short-term interest rates while maintaining an exceptionally small footprint in the broader financial markets. The devastating 2008 financial crisis and the subsequent introduction of quantitative easing permanently ended the scarce reserve era. Today, the Fed operates under an abundant reserve model, where the baseline for reserves has shifted to over $3 trillion. Looking at the updated chart, reserves are now 60 times higher than pre-crisis levels, accounting for roughly 30% of the total money supply. In this environment of abundance, small open market operations no longer impact the federal funds rate. To maintain control, the Fed now relies on the interest rate it pays directly on these reserve balances to keep the market near its target. Transitioning from surgical operations to a system of sheer mass, the Fed evolved from a nimble participant into a heavy, interest-paying floor. Why do modern banks require 60 times more reserves today than they did 20 years ago? The primary driver is regulation. Following the 2008 crisis, new liquidity mandates were introduced to ensure banks survive panics. They must hold massive amounts of high-quality liquid assets. Reserves are the ultimate asset, carrying absolutely zero risk. Federal Reserve Governor Stephen Miran refers to this dynamic as regulatory dominance. He argues that the regulations themselves have created an insatiable demand for reserves, forcing the Fed to maintain a much larger balance sheet than it otherwise would. This explains the stall in quantitative tightening. As the Fed drained reserves, the supply collided with mandatory regulatory requirements. To prevent banks from falling below legal minimums, the Fed stopped the drain, injecting $40 billion back every month. Quantitative tightening cannot continue indefinitely because it has hit a rigid floor created by the banking rules themselves. The irony is that even the Federal Reserve admits it does not know the exact mathematical point where reserves move from being ample to scarce. The demand for these reserves is a moving target, shifting based on how banks calculate their own risks and how they perform in regulatory stress tests. This diagram visualizes the conflict paralyzing the Fed's operations. Monetary policy seeks a smaller balance sheet, while regulatory compliance demands maximum reserves. These goals are in direct opposition. Attempting to tighten the money supply threatens a bank's liquidity compliance. When these two mandates clash, regulatory dominance ensures that the rules for bank safety take precedence over the goals of monetary policy. This is the wall facing Chairman Kevin Warsh as he tries to reduce the Fed's role in the financial system. The structural challenge is now effectively locked in place. The debate over the boundary of the Fed's power is no longer just about money and interest rates. It is now driven by the requirements of bank regulation. Warsh cannot simply use more quantitative tightening to achieve a smaller Fed footprint. If the Federal Reserve truly wants to shrink its balance sheet, it must first address the regulatory framework that makes a large balance sheet mandatory.